Well, good afternoon. Happy Friday, September 12th. Mark Milam here, your mortgage professional. 2 weeks in a row. We are 2 weeks in a row at the lowest levels for mortgage rates in 2025. And listen, we'll take it. This time last year, we were at the lowest levels of 2024. We were approaching a Fed rate cut. The Fed cut by a half a point, and we saw mortgage rates take right back off as we move through the last quarter of 2024. And it's taken us an entire year to get back close to those same levels. But we're back here again, and we're facing a very similar set of circumstances. We have a weakening labor market. Inflation is not back to 2%. Inflation is still high. We still have a national debt that is climbing. Our budget is still not balanced. And the Fed is likely to cut the Fed funds rate here in September. So this is going to be really interesting to see how much history repeats itself, especially after the Fed rate cut that is for sure coming next week on September the 17th. Expect the Fed to cut the Fed funds rate by a quarter of a point. Now, last year they cut by a half a point. I think if they could go back and do that over again, they would not have had that jumbo-sized rate cut because the market sure didn't like it, especially the long end of the yield curve where mortgage rates live. So why are we improving? Why are we anticipating now that the Fed is going to cut the Fed funds rate? Well, it's because the labor market is softening, and we get a host of labor data throughout each and every month about what's happening with the labor market. This is non-farm payrolls, or maybe it's the unemployment rate, or job openings, labor turnover. All of these are indications of labor strength or labor weakness. The problem with all of them, though, is that they're largely surveys, and some of the survey response rates are extremely low, and the data has proven to be quite flawed. In fact, going through a recent analysis, a quarterly census of employment and wages, we found that the labor market overstated job creation for the past year. If you go spring of this past year to spring of the year before, overstated job creation by 911,000 jobs. That's an enormous miss. In fact, it's a historic miss, largest miss that we've seen in the modern era. And so that calls into question a lot of our labor reporting. But here's what you can't question. The one labor report that is rock solid, that's data driven, not survey driven, are jobless claims. And we're talking about those who are filing either for their first round of unemployment or continued unemployment. And jobless claims are really the canary in the coal mine that will tell you if the labor market is starting to truly soften and if interest rates are going to begin coming down, because this is the last hurdle to fall here, the labor market. So let's take a look. We get jobless claims each and every week. I want to scroll down the screen and show them to you because we certainly get measures of inflation. But this report right here, jobless claims, that comes out each and every Thursday, is going to become more and more important. The estimate for jobless claims was 235,000. That came in higher at 263,000. That's a very big miss to the high side and fueled the fire that says the labor market is now softening. It's a strange thing to hope for or maybe to get excited about because you certainly don't want anyone to lose their job. But the labor market softening or weakening is the last thing the Fed needs to see to get comfortable cutting the Fed funds rate. And that's exactly what's happening. So from the world of mortgage rates, whether you're buying a home or refinancing a home, the good news is already here. Mortgage rates have baked in that Fed rate cut that's coming next week. There's no reason to wait on the Fed. In fact, the Fed is the last car of the roller coaster. Mortgage rates are the first car of the roller coaster, so we're already there. That's great news. What's going to happen after the Fed cuts the Fed funds rate? Wow, that's a good question. And let's take a look at recent history to see what it could mean. And I'm going to focus in on this slide right here to show you. So this red line are mortgage rates, and the blue line down here are the Fed funds rate. So this is last year, this is 2024, and you can see August to September of 2024, mortgage rates were declining nicely, right? In advance of what would eventually happen when the Fed cut the Fed funds rate. So here we are in September of 2024, the Fed exercises a half-point cut in the Fed funds rate, and what did mortgage rates do? They turned right back around and went right back up. And why did they do that? Well, inflation was still high. It wasn't back to 2%. We still have a lot of national debt out there, meaning we're going to have to sell more and more of our government debt to fund our expenditures. And there's also this phenomenon in the world of trading called buying the rumor and selling the news. Traders move in advance of what they think is going to happen. And listen, how often in trading do you 100% know what's going to happen? It's very, very rare. But in the case of mortgage bonds and interest rates, you kind of do know because we know what the Fed is about to do. The Fed has telegraphed that they are about to cut the Fed funds rate. So traders are now moving in advance of that, buying the rumor. When you get to the actual news, will traders take their gains and sell out of their positions, putting upward pressure on mortgage rates? That's certainly a potential to happen. So I think there's three things we have to pay attention to. Number one, inflation is still not back in the bottle. It's still over 2%, CPI coming in at 2.9% this week. Buying the rumor. This is just a phenomenon of trading where traders are going to buy the rumor that the Fed's going to cut, the Fed will eventually cut, and then they're going to sell the news. So we have that to think about as well. And then, of course, our national debt. Will the same thing happen now as we move into 2025? It remains to be seen. No one can predict the future, but boy, it's eerily similar. Look at mortgage rates moving lower in advance of a Fed rate cut. What will they do after the Fed cut? We don't know. One thing we do know is that in the modern era of the 30-year fixed, the 30-year fixed has never gone below 5.4% unless the Federal Reserve was buying mortgage-backed securities. Here we go. In November of 2008, the Fed began buying mortgage-backed securities, and the 30-year fixed dipped below the Mendoza line of 5.4%, and we enjoyed historically low interest rates for a very long time, up to 14 years, until spring of 2022 when the Fed stopped buying mortgage-backed securities. And that's when mortgage rates went back above the Mendoza line. So the takeaway here is, listen, we're in great position. If you're out there looking to potentially buy a home or refinance a home, you couldn't have picked a better time. These are the best rates of 2025. Does that mean we're going substantially lower? I don't know. We'll have to wait and see. But if history is any guide, I don't think there's a lot lower that we can go. We can hope for that, and that certainly would be welcome news. But odds are somewhere between 5.5% to 6% is where we're going to land, at least for the short-term future. And so now's a great time to go ahead and lock in and take the purchase, take the refinance rate that you've got. It's way better than anything else you would have gotten thus far in 2025. And at the best levels, really, we've seen post-pandemic. If I can be of any service to you over the weekend, don't hesitate to reach out, mark.milam@highlandmtg.com.